Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There is just an hour to go until the closing bell, and stocks looking here, we are headed lower. The Dow is actually basically flat here. The S&P 500, though, that's down about 0.4%, and your tech-heavy Nasdaq, that is down about 1% in today's trade. Let's welcome now the head of research at Wall Street Horizon, a TMX company, Christine Short, and our data and markets editor, that would be Jared Blickery, joining us here to break down the headlines. Jared, we'll start with you on today's trading action.
A little bit of Groundhog's Day going on here. Dow just about flat as it was yesterday in the close. A little bit of green there. Nasdaq, as you said, led down by tech here. You can see down almost 1%. S&P 500 losses are about half that, or 0.4%. We'll also check in on the small caps. Russell 2000 down about 0.6%. And I just want to show you a chart here. This is today in the Nasdaq. I'll show you the 2-day slide, and we are now approaching about 2.5%. So we have seen a little bit more selling than we're used to seeing, because we've been seeing a lot of record highs, and with that usually comes kind of the boring low volatility days, but not these last 2 days. Here's the 10-year T-note yield. I'll put it back on today's action, down 1 basis point. The 30-year just about flat, and the US dollar index also moving a little bit south here, but really nothing to be worried about, nothing big standing out. And in the sector action, once again, tech leading to the downside, and today we have consumer discretionary as well. We got some earnings from big boxers, not only today, Target, but we're also going to take a look at what's happening throughout the week there. So that's that story. Those are underperforming. What's green here is energy. That is up over 1%, followed by staples, healthcare, then financials, real estate, utilities. Most of these sectors up here are defensive, and so we are seeing a little bit of a defensive posture in the markets. And we can see, if we take a look at the Nasdaq 100, lots of red, especially spread around the bigger stocks, the mega caps. And we can see the selling concentrated in Tesla and Broadcom down about 2%. Nothing real big here. I don't see a lot of stocks down more than 3%. Intel is notable, by the way. That's down 7% after being the leader in the Nasdaq yesterday. Micron also down about 5%. But other than that, pretty mixed board, and a similar story playing out in the Dow 30. We do see a lot more green than red, though, once you discount those big names that we've been talking about. United Health, another standout, down about 1.75%. And speaking of big boxers, we got Walmart up 1%. And I want to go to our retail board here so we can see some of the action in here. I just did Walmart. Costco also up 1%. TJX coming off of earnings up 3%. Target here down about 5.7%. I'll give you a year to date on that. Down 26.5%. Sure, we'll be talking about that today. And on that note, I'm going to send it back to you, Josh.
All right. Thank you, Jared. Appreciate it. Well, the big story today, that would be Target. Shares sliding after the company picked a new CEO, Target insider Michael Fidelki. He will take the helm on February 1st, 2026. That announcement came after Target beat low earnings expectations. The company posted its second quarter of same-store sales declines after seeing 3 positive quarters before that. Joining me now is senior reporter Brooke DePalma. So, Brooke, who is Michael Fidelki, the next CEO of Target, and why, Brooke, are we seeing shares respond like this?
Yeah, Michael Fidelki is a lifelong Target employee. He's an internal candidate the company chose over what they said was a pretty rigorous, extensive search. Now, it's important to note here that Fidelki actually started out as an intern back in 2003, and he went on to serve as both CFO for 4 years and COO, or more than 4 years, nearly 5, and COO for nearly 2 years. Now, the company and the big box retailer did give us a bit of a hint back in May, because they led him or named him to lead the Enterprise Acceleration Office. And then ultimately what that means, it was a multi-year commitment that Target has made to really return to growth here by doubling down on speed, adaptability, and innovation. He'll continue to oversee that commitment as he's set to take the helm come February. Now, the stock is falling here because, well, they went with the internal candidate. And this is somewhat of what Wall Street didn't want to see, and at least that's what Mizzou analyst David Bellinger told us this morning.
And Brooke,
so about a month ago, we did this survey. We polled 50 plus large investors looking at the consumer sector who are familiar with Target, and 96% wanted an external hire. So that it gives some credence to the move today. We basically heard that Target needed someone new to bring wholesale change.
And the market had anticipated a CEO change because we knew that the current CEO, Brian Cornell's 3-year agreement was set to end. But one Citi analyst also writing that investors here wanted an external CEO, and that's what they were hoping for.
And Brooke, do we know who else was being considered for that job, or who else Wall Street thought maybe it could be?
Yeah, ahead of what we knew this 3-year agreement ended, I had gone out to my sources over the course of this summer, and I largely asked them, who could take the helm? And many of them were saying, hey, Fidelki looks like he could be the one, but they also looked at others. They were looking at external candidates, rather Wall Street, these analysts and these sources that I spoke to were looking at others, including Tractor Supply CEO Hal Lawton. They said he could take the job, but it would take a lot for him to leave Tractor Supply. Another candidate that was potentially on the table, they thought, was Mary Dillon. She's currently CEO of Foot Locker. We know that Dick's is acquiring Foot Locker. She also led quite the growth at Ulta, so they thought of that as potential. And they even mentioned a few Walmart executives' names, like Walmart International CEO Kath McClay as a potential option, as well as her Sam's Club CEO Chris Nichols. Both of those likely have a agreement with Walmart that they will not work at another big box retailer. So they were off the table as well. So it seemed, according to my sources. And so this ultimately led to Michael Fidelki, who once again has led operations at Target for quite some time. It'll be interesting to see what exactly he does when it comes to their speed, adaptability, but also innovation, and largely what he'll do to just get people back in the door at Target in the coming months and years. It seems like he said, as he doubled down on the call, that he's acting with urgency.
Christine, I want to bring you in here as well, get your thoughts on the news for Target, Christine, but also the stock reaction. Stock is getting hammered. It's down about 6% in today's trade. You see that reaction, Christine. Does that make sense to you? Does it seem justified to you, Christine?
Yeah, I think for the reasons Brooke brought up, because it wasn't top and bottom line. I know those estimates were lowered, but they did beat, which actually I was surprised to see. They didn't cut full year guidance like they did in the first quarter. But many analysts were looking for an outsider that could come and shake this company up, which has been struggling for a couple of years, especially when you compare it to peers like Walmart, and they've been having issues with product mix. And, they used to offer unique products, and that was sort of the cachet of going there, as it was a slightly more elevated experience with customer service and unique product mix. So you've got that kind of going to the wayside over the last couple of years. In addition to that, you've got the introduction of tariffs. Keep in mind only 50% of their business or 50% of their items are produced in the US versus someone like Walmart where 2/3 of the items are produced in the US. So they have reduced their reliance on products made out of China down to 30%. That was about 60% in 2017. And Brian Cornell said last quarter they're going to try to get that to 25% by the end of next year. But on top of the tariff issues, you've got the weakening of the consumer, and the consumer is really turning towards grocery and necessity items, something that Walmart's doing better with. 60% of Walmart's business is grocery versus about 20 or so percent of Target. So when you compare that, Target isn't quite the one-stop shop that maybe a Walmart is. Their food and beverage did great last quarter and this quarter, but it's really the only segment that's continually been outperforming. But things like beauty, apparel, hard lines, they've all been struggling.
So, Christine, you did mention Walmart. Of course, those earnings are on deck. What are you going to be listening for there, Christine?
Yeah, so with Walmart, we're just going to be listening. What are they seeing in consumer strength, foot traffic, ticket price? They certainly are seen as the beacon of value, and they said even despite tariffs and costs might increase, but they were really going to try to price protect for their customer. They've seen the high-income customer trade down, so we want to hear if that is continuing to happen. So they're going outside their usual target audience, and they are finding customers amongst the higher income. How the grocery business is, again, Walmart's seen as this one-stop shop where you go for groceries, and maybe you stay and you spend your discretionary income. They also have gasoline at some locations as well. So a little more of a one-stop shop. We also want to hear about their online marketplace. We know we're working with third-party sellers. They're trying to take on Amazon there. So I think a lot of highlights and a lot of tailwinds for Walmart, despite the other tariff and softer consumer headwinds that they'll face.
And Brooke, your thoughts there?
Yeah, well, Christine said that the groceries are the name of the game right now. That's what consumers are going for. And Walmart, with their Walmart Plus subscription, I'm curious to hear how membership is going there. We know that Amazon just launched that same-day delivery for perishable goods as well. And so they really need to up their ante when it comes to the momentum that they already have behind their same-day delivery. But convenience is just so essential right now to win over the consumer. As Christine noted, they've been able to win market share of high-income consumers. That was Target's bread and butter of just a few years ago. And so seeing the momentum that tomorrow morning from Walmart will be really interesting when it comes to them doubling down on same-day delivery as far as groceries go, convenience, and also how they continue to win over market share with that low price model that's not only attracting, what was the low income consumer, but now all income cohorts as well.
All right, Walmart on deck. We'll be watching. Thank you, Brooke. Markets walking a tightrope right now, supported by resilient consumer spending and some stronger than expected earnings, but also weighed down by inflation worries and fiscal pressures. Will the rally prove durable, or are investors underestimating the risk? Let's bring in now Eric Friedman, Chief Investment Officer at U.S. Bank Asset Management Group. Eric, it is good to see you. So I actually want to start kind of big picture. The market moves we've been seeing here, Eric. My colleague Jared Blickery was just breaking it down. Tech kind of under pressure here again, Eric. The same story. I'm just curious what you make of that. Is that, you look at that, Eric, do you say, big deal, no deal? What are you telling clients?
Yeah, we think it's definitely something to pay attention to, but we still retain that glass half full perspective, Josh. And I think as you evaluate earnings season, and of course we have a huge earnings figure coming up next week with NVIDIA, but I think if you look at the general tone, the general tailwinds of spend in terms of enterprise spending on things like cyber as well as big data, those continue. I think that what you're seeing from investors is, again, evidence that spend is actually translating into value add for shareholders. That's not a universal. It's not like, maybe a year ago where it was like, hey, as an investor, does a company have an AI strategy? And if so, the stock was rewarded. Now it's more about, can you show some tangible value behind what you're doing? So again, noise like the last couple of days, I'm going to dismiss it. It's certainly on low volume days where in particular options activity is probably more important than what's happening in the cash equity market. That can almost exacerbate some of these realities. But we do think next week is important. Obviously, end of this week, critical with the Jackson Hole outcomes. But again, we think as long as that enterprise spend continues and there is some tangible return on that capital deployed, we think tech is still a place you want to be invested in.
With AI and tech in focus like this, Eric, how much pressure on NVIDIA next week, those earnings, the face of AI, how important is that print going to be for the market?
Yeah, it's going to be really important, Josh. One of the things that's different this quarter, I should say this year, is you're starting to see a more diffusion of AI spend across other chip makers. So with the advent of DeepSeek's progress, with the advent of, again, AMD and even now Intel being a bit more in the limelight, nothing cures high prices like high prices. As you've seen more entrants into the overall chip realm, if you will, I think that, again, NVIDIA remains the most important name in the category. That being said, that diffusion of AI technology is starting to happen. And so that's actually a good thing for companies. It's a good thing for industries in the sense of more efficiencies being brought out. So again, without question, the category leader remains NVIDIA. That being said, that increased participation across a broader swath of companies is ultimately a good thing for the industry and a good thing for the sector writ large.
Eric, you also mentioned Jay Powell, Jackson Hole on Friday. We're all going to be tuning in. Which Jay Powell you think shows up, Eric? Is it neutral, dovish, hawkish Jay? What do you think?
I think if I had to affix a word, Josh, it would probably be incremental Jay Powell. And what I mean by incremental is that the Fed has had several opportunities to walk back that 2% inflation target. And of course, they haven't done that. They've kept at that 2% number. I think if we asked for a show of hands, especially in your backyard in New York, not too many people see a consumer basket growing at only 2%. But I think that, what Jay Powell wants to really think about as a steward of the next realm of rate decisions is that notion of being very gradual. Again, clearly, if you look at some of the data we had last week, both CPI and PPI rounding at about 3% at the inflationary level, that's hotter than what the Fed is looking for. We do think the Fed is willing to round down a bit. I think if you see a print normalizing at 2.5, 2%, 2.6%, that's probably enough for the Fed to, again, cut interest rates probably twice this year, but be a little more guarded about what may happen next year. So again, that more incremental, let's call it pragmatic Jay Powell is probably who we'll hear from as we assess what happens in Jackson Hole or later this week.
Let's bottom line this, Eric. How do you want to be positioned in the stock market right now, Eric? What sectors interest you? What are you also less interested in?
Yeah, I think that our go-to playbook right now remains tech, comm services. We like financials. Probably an area that gets a lot less attention, Josh, is global infrastructure. You think about what that entails. It incorporates utilities. It incorporates infrastructure, obviously because of the name. It also incorporates, transportation, as well as other subsectors that have some level of both yield and income, as well as an inflation hedge. That's an area that we think, again, spits off cash flows, is very measured, and we think is a worthwhile thing. I think things that we're less interested in would be consumer staples writ large. We think they're a little expensive. Also think more of the wants versus needs. Wants are still a little bit, we think elevated from a pricing standpoint. So again, consumer staples, less interesting. Global infrastructure, tech, financials, those are spots we still think are great opportunities for investors at current levels.
Eric, last one for fixed income investors listening, Eric, your advice, your guidance.
Yeah, I think for those who are taxable, municipal fixed income remains a great place to be. Again, gross up taxes, you're talking about yields on the high yield muni side, north of 9-10% on a tax adjusted basis. You can't find that in many other spots. We also think that owning other sources of income, things like reinsurance, things like non-agency mortgages, not items that you're going to find in an ETF. Those are things that investors like us really like in an environment like this to get some differentiated cash flows beyond corporate credit, which we think is pretty expensive, and also governments, which we think is a little less interesting here as well.
Eric, always good to see you. Thank you, sir.
Thanks, Josh. Good to see you.
We are just getting started here on Market Domination. Coming right up, tough streak for Palantir in recent days. Despite being the most significant gainer to date in the S&P 500 this year, we're taking a deep dive with an expert on what's going on, how to play Palantir right now. Plus, what's old is new again. Hertz partnering with Amazon in a unique way. We're going to explain what to expect there. And Abercrombie & Fitch may be seeing more than a change in wardrobe. Those stories and more when we return. Stay with us after the break. Palantir on track to close lower for the sixth consecutive session. It has been the worst performer in the S&P 500 this week. It's down more than 15% over the past 5 days. For more, we're bringing in Louis DePalma, research analyst of industrials at William Blair. Louis, it is great to see you. So let's talk about Palantir. Under some pressure again here today, Louis. I mean, obviously we should note tech broadly is lagging here. It's not just Palantir, but there have been skeptics, Louis, who come on my show. They say, listen, they like the company, they like the tech. They don't love the valuation. Walk me through what you think's going on here. What do you make of the recent price action in Palantir?
Definitely, and thanks for having me on the show. So looking at Palantir from the big picture, they just posted one of the greatest quarters financially of all time, in that their quarter was a rule of 92, in that they had 46% revenue growth and a 46% adjusted operating margin. And both of those figures are amongst the highest in all of software. So why is the stock getting pummeled? It's because investors are sniffing of any sign of weakness because the company trades at such a high valuation associated with that rule of 92 score. It's by far the most highly valued name in all of software. And the different data points of weakness that have come out recently are that OpenAI is aggressively pursuing enterprise AI projects, and that is the domain of Palantir. Also that there's an AI talent war, and OpenAI is aggressively hiring from Palantir. And also Databricks yesterday announced that it raised funding at a $100 billion plus valuation, and they're also considered a competitor. So those three data points have contributed to the sell-off over the past week.
And I know, Louis, you still remain, I believe, market perform. So you remained on the sidelines here. What would it take, Louis, to get you more bullish on Palantir?
Yeah, if Palantir fell by 30 or 40%, then the valuation would definitely be more appealing. The major bear argument for Palantir is just valuation. As I said before, the financials that it's posting are amongst the greatest of all time of any company in software. The question investors will be asking is over the next several quarters, will Palantir become a rule of 100 company? So normally in software, the bar is set at rule of 40 in terms of adding the revenue growth and margin profile. But Palantir is literally in unprecedented type conversations because it has such pricing power for its government contracts and its commercial contracts.
It's interesting, Louis, because we had Brent Bracelin on the show. And you know Brent, he's been doing this a long time like yourself, smart guy. He initiated Palantir to outperform. So he was telling his clients to buy. On that valuation question, Louis, Brent told me, he said, listen, I concede it is a richly valued company. He also argued to me though, Louis, he said, listen, I'm outperformed because I think this is a one of a kind, in his words, growth and margin model. What do you make of that?
No, he's right. It's just the fact that Palantir is vulnerable, just like it's declined by, I think, 22% over the past 6 sessions. And between, I believe it was February and March, the stock declined by 45% without any specific news. There are, investors that are going to nitpick here because it's priced to perfection. And so Palantir could easily go down to $100 and it still would be richly valued. If you're going to look at Palantir with a 5-year time horizon, it makes sense to envision that OpenAI is going to become a more formidable competitor, and Anthropic and Databricks, in that they're raising funding, they're hiring talent from Palantir. They are tremendously innovative companies. So Palantir's market dominance may not last. I saw in the previews that you guys are going to have Tristan Thompson on Yahoo Finance on Friday, and he was part of the Cleveland Cavaliers 2016 championship team with LeBron James. And LeBron James, similar to Palantir, you could say is the greatest of all time in 2016. But now, you would point to maybe Giannis Antetokounmpo, or you could point to Steph Curry. And so at some point in the near future, Palantir may be hitting its ceiling in terms of the valuation multiple. And then, as a function of, where is the multiple going to stabilize?
I love the NBA comparisons, Louis. You can say that on the show anytime. Appreciate it. Let me get you a broader question, Louis, because at the top I mentioned, listen, it's not just Palantir. There's broader pressure on tech, Louis. I'm just curious to get your take on that, what you make of it. I mean, we're trying to figure out, Louis, as investors, is that just this kind of late summer thin trading hiccup, Louis, or no, are we seeing the start of something more meaningful here that we need to be paying attention to?
Yeah, there are different levels of quality within tech. I cover defense tech, and as part of that coverage is Palantir. And, we cover other companies that have a premium valuation, such as Karman Space and Defense, which is a merchant supplier to drones, missiles, and missile defense industry. I cover AeroVironment, which is a really high quality drone company with a $1 billion contract for loitering missiles. But there are, different levels of quality within software and tech, and investors right now are sifting through the quality. I would say Palantir is high quality, and that's evidenced by its rule of 92. But we cover other high quality names. And if investors want names that are more defensive, we recently upgraded Booz Allen. We upgraded CACI International. Both are defense tech plays, software development, cybersecurity, artificial intelligence, data analytics. We also upgraded Viasat, which is launching a satellite called their Viasat 3 terabit satellite in the next 3 months. So there's a lot of interesting plays in the stock market amidst this sell-off.
Louis, appreciate your time and those picks. Thank you.
Awesome. Take care.
Now time for some of today's trending tickers. TMX Group's Christine Short is here with me, taking a look at NVIDIA. Got Hertz, got Abercrombie and Fitch, but let's start first with NVIDIA. KeyBank Capital Markets lowering its third quarter estimates to exclude direct China revenue contributions. So this is KeyBank's John Vin, Christine, friend of the show. Now, he's overweight the name. What he's telling his clients, he says, we expect NVIDIA to report strong Q2 results, he says, and guide Q3, he says, slightly below consensus. The reason, Christine, is he's saying we expect NVIDIA's outlook to exclude direct revenue from China, given pending license approvals, the uncertainty on timing of all that. If NVIDIA were to include China, he says in his guidance, we think it would contribute an incremental $2 to $3 billion in revenue. Bottom line, John reiterates the overweight, takes his target to 215. What do you think?
Yeah, I was going to say he increased his target.
Yep.
And we've seen this with other names. AMD, it's just really hard to figure out the China picture right now. Like you said, between the kind of handcuffs they have on what they're allowed to export and then this potential 15% tax.
Maybe a little kickback to Uncle Sam.
Right, the 15% tax to the U.S. government on, if they do start sending those more advanced chips to China. We know even though they've tried to kind of slow some of the export laws around that, those chips are still getting there. So that shows both the demand and then the way they're enforcing it isn't completely tight. However, it's those headwinds that makes it really hard for them to predict revenue, as well as the Chinese government is trying to encourage the use of domestically produced AI chips. So you've got a lot of those things going against them. I think for NVIDIA, 13% of revenues come from China. AMD, it's almost double that, I think 24%. So it's a pretty big chunk of change. So I understand the reason that KeyBank is saying this, but they still did up their price target. It's just really hard at this point for NVIDIA to confidently give you an outlook. And so when you can't do that, they won't give it, right?
All right, big print for the AI trade and the market. Meanwhile, let's look at now at Hertz as well. The car rental company announcing it's teaming up with Amazon to sell pre-owned vehicles. So this one, Hertz striking a deal, Christine, with Amazon Autos to sell some of its used car inventory. It looks like customers are going to be able to search Amazon Autos to browse, finance, purchase. Got thousands of used Hertz fleet vehicles here. We're talking about brands Ford, Toyota, Chevy, and Nissan. Hertz saying the sales will begin in the Dallas, Houston, Los Angeles, Seattle metro areas. What do you think?
Yeah, I mean, this comes on top of the news last week that Hertz was expanding its rent-to-buy program to 100 cities across the U.S. This is something that they're really trying to be innovative with how we buy and purchase and test drive cars, right? So the program allows folks to test drive a car for 3 days for some nominal fee. And, it's a better experience than just taking it off the lot, taking it for a spin, especially when this is one of the biggest purchases some folks will make outside of maybe a home.
Sure. Yep.
And so, especially in this environment where you have customers that are a little bit leery to spend money, they're looking for trust and transparency. Hertz has already said that 80% of the renters in the program go on to buy a vehicle that they have test driven. So I think it only makes sense to partner with Amazon. It also helps Amazon with their auto sales business. So for both of them, I think Hertz is just looking for other lines of profitability, which makes sense because the rental side has struggled. But yeah, this rent-to-buy program sounds like it's off to a very good start.
Yeah, Hertz popping 4% in today's trade. Last, let's look at Abercrombie and Fitch getting hit with a downgrade over at Citi, firm noting it expects lower fiscal 2025 guidance. So Citi just goes to a neutral, Christine, on this one. It was it's part of a broader note. They say we believe specialty apparel retailers are going to be challenged to offset tariff pressures with higher prices. They see elevated gross margin risk in the back half of the year. Impact, they say, flowing into the first half of fiscal 26. We believe this makes for a, they say, tough setup over the next several months, especially against the very strong holiday in 24. What do you think?
Yeah, and like you said, it's not just Abercrombie. They listed Gap, Urban Outfitters. The segment as a whole, apparel, not expected to do very well for all of the reasons that you mentioned. Unless they offer very deep discounts going into the holiday season, which we saw they had to do last year, it's going to be hard to get that discretionary income from consumers, right? But as you point out, it's a double whammy because they're going to have the increased cost of tariffs, but customers likely aren't going to come in through the doors unless they feel like they're getting a deal. I think you're going to see the apparel, the traditional apparel outlets losing out to the off-price retailers. We saw TJX companies out today. You pointed out the stock is way up. They don't have to deal with tariffs as much. They're getting the excess inventory from other brands. So those are items that have already been tariffed, and they're also perceived as offering value, a bargain, and that's something that the consumer is looking for right now. So I'd expect to see the same maybe from Burlington, Ross stores, but yeah, for right now, for back to school, as well as the holiday shopping season, it is going to be a little tough for the likes of Gap, Abercrombie, Urban Outfitters, and some of these in the specialty retail space.
Abercrombie down about 3% today's trade right now. Stay with us. After the break, we are talking two unique tickers with an expert who will advise us on which is a good buy or maybe time to say goodbye. That is coming up next. Welcome to Goodbye or Goodbye. Our goal here is to help cut through that noise to navigate the best moves to your portfolio. I'm here now with Zacks Investment Management Senior Client Portfolio Manager. That would be Brian Mulberry. Brian, it's great to see you, as always. Let's start here with one name you like, Brian, and that would be Amphenol. Now, this stock, it's a nice move already, Brian. It's up about 55% this year. Most on the street like it. You like it too. Let's go through the reasons why. The first reason, you say global leader in its industry. Let's take a beat right there, Brian, for the uninitiated. Walk us through what exactly this company does.
Absolutely. This is one of the most important names you may have never heard of. Amphenol is a global leader in the design and manufacture of electrical connections. And so what they've done over the last 10 years is really help build out the 5G network and fiber optic connections in most of Europe and also other parts of the world as well. So they're very, very good at creating and manufacturing and designing these electrical connections. They've recently just got a deal with NVIDIA to help build data centers here in the United States.
All right, bullet point number 2, why you say this one's a buy. Benefiting from demand in 5G expansion. Walk us through it.
Right, so obviously demand for 5G as a service has been growing for the last 10 years. That's a big part of their market. But now the segment of growth is increasing into data center build-outs as well. So their techniques and their expertise in this area specifically leads to a lot of growth. Their last earnings surprise was up 22% just in the last quarter, and that leads to better gross margins as well.
Let's go to the third reason. You say this one is a smart one to commit capital to support for future growth.
Strong balance sheet here. They've been a really good steward of all of the revenue that they've been generating recently. They've got a strong dividend, and all of this growth could lead to better treatment for shareholders, meaning increased dividends and support for growth. If they need to acquire companies to expand rapidly, they have the cash on hand to do exactly that.
All right, so you make your case convincingly as always, Brian. Before everybody jumps in, though, walk the viewers through what are some risks you got to think about.
Because the majority of their revenue has come from overseas, the biggest risk for them is the currency rate exchange. The soft dollar recently has helped some of this growth rate go in a positive direction, but if we see a reversal and the dollar gets stronger, that could be a headwind for growth in the future.
All right, so that's what you like. Let's turn to one you don't like. You would avoid Vertex. Now, this stock is basically flat year to date. Let's walk through the reasons why you don't see too many catalysts ahead. One reason you would avoid it, overly dependent on one market.
Vertex is a leader in cystic fibrosis treatments. There's no question about that. They have 5 different products that treat that one area, but that's really the core of their business. They've tried recently to branch out into some other areas like pain management and things of that nature. It just hasn't gone well. So being concentrated with one real consumer of their product and that spending is going down makes us a little bit negative on the name.
Second reason you're negative, some products developing slower than expected.
Yeah, as I said, that pain management program that they were working on, the trials were so poor, the efficacy was so bad, they actually had to pull it. So they didn't even get to a point where they were trying to seek approval. And there's obviously a lot of cost in developing these types of drugs. It just didn't go anywhere. So again, a net negative on profitability.
All right, third reason you want to avoid having this one in your portfolio, competition increasing.
So not only are we seeing fewer dollars spent on cystic fibrosis treatment, we're starting to see other carriers come into the space with newer products, newer delivery systems. So competition is increasing, on a declining pool of dollars out there. So it just makes growth a lot more difficult to achieve for a name like Vertex.
Finally, though, on here, Vertex, what's the upside risk, Brian? How could you be wrong on this?
Well, they are really good at what they do. As I said, their core competency is in cystic fibrosis. They have a new treatment that's recently been approved that could become the new standard of care, meaning it could treat 90% of patients 6 years and over. That could actually be the one component that adds growth back into it. But for us, all of the other headwinds just line up to be too much to overcome.
My bottom line, buy Amphenol, avoid Vertex. Brian says, thank you, Brian, for your time. And thank you all for watching. Goodbye or goodbye. More market domination coming right up on the other side. President Trump calls for Biden-appointed Federal Reserve Governor Lisa Cook to resign. The potential firing of Lisa Cook comes amid reports of a housing official accusing the Fed governor of mortgage fraud. StoneX senior advisor John Hilsenrath joins us now to discuss, along with TMX Group's Christine Short. John, great to see you, as always, sir. So let's get into this. So Trump targeting Fed Governor Lisa Cook, calls on her to resign. This follows his accusation of mortgage fraud. John, you saw that post by the president. You saw the headline. What did you make of it?
Well, there's a lot to unpack here. So the head of the Federal Housing Finance Association, which oversees Fannie Mae and Freddie Mac, is accusing a Fed governor, Lisa Cook, of mortgage fraud. The allegation is that she listed 2 different residences as her primary residence when filing mortgage applications, and he referred her to the Justice Department for fraud. That's not allowed. This is, in my mind, a serious allegation, but there's a lot of facts here that we don't know. There are cases, for instance, where a person could list 2 homes as primary residences, for instance, if they're co-signing for a dependent, an elder, or a child. So we just don't know the facts. It seems like a pretty aggressive move to refer her straight to the Justice Department. The undercurrent here is that she was a Biden appointee. President Trump wants to get rid of Biden appointees on the Fed board, put his own people on there, and push for a more easy, lower interest rate monetary policy. So this is part of that bigger narrative.
And it was interesting because I did see Bill Pulte, the FHFA director, in an interview today, John, and he was making the case that he said they got a tip. I believe he called this a serious issue. He did, as you know, allege mortgage fraud here that she was claiming. He says alleging primary residence 2 places at once. His point was, John, that John can't do that and Josh can't do that and Lisa Cook can't do that. And so how do we, and he also did, John, say he thinks she should step down. I believe he said the word quickly. As we try to game out how we think this goes, John, can we say now or no? We have to kind of see what does Pam Bondi at the DOJ do with it?
Well, I mean, I think it depends on the facts of the case. So if she did that and there were no exculpatory circumstances and it was mortgage fraud, then like that looks like a pretty serious offense. You're not allowed to do that. That could be seen as mortgage fraud and potentially even tax fraud if that's the way she reported residences on her tax forms. But we can't say that that's the fact, because it is not always and everywhere the case that you can't list 2 residences as primary residences. I gave 2 examples where if you're co-signing for a dependent, it might be a case where you have one residence and then you're moving and buying another residence. That's also, a special circumstance. So I don't think that we could, I don't think it's responsible to make allegations without knowing all of the facts. And that's where Bill Pulte might be moving a little bit aggressively here, unless he knows more than he laid out in that letter. I think we need to find out what were the circumstances of those mortgages that she applied for back in 2021.
And Christine, I want to bring you in here as well, because you saw the president's post, Christine. You saw the headlines. What did you make of it?
Yeah, maybe no surprise here. It's not the first person that President Trump has come after in the Fed as they look to fill the Fed leadership with folks that will push looser monetary policy. He's looking to expedite the Senate confirmation on Stephen Miran as a Fed governor in hopes that interest rates will be cut. That's something that he has had a bone to pick with Fed Chair Jerome Powell. And judging by today's FOMC meeting minutes that just came out a couple hours ago, most members of the Fed seem quite hawkish. I think only Chris Wallace and Michelle Bowman, of course, he is one of the top picks to take over Fed Chairman Jerome Powell's spot when his term comes up in May, and Michelle Bowman were the two that said that the risks of lower employment and sort of the labor market outweighed those of inflation, but really 9 of the 12 Fed members were still very much focused on inflation. So it makes you wonder what the probability of a September cut. The CME Group's FedWatch tool still has it around 80%, but you wonder after those minutes came out, as well as the Jackson Hole speech that we're all waiting for on Friday, how that will change the probability of rate cuts for the rest of this year.
John, Christine mentioning Jackson Hole. Of course, I have. You got to ask you, Jay Powell, Jackson Hole Friday. What do you expect to hear, John? What are you listening for?
Well, so I think he's going to open the door to a rate cut, very slightly open the door in September. And the reason for that is, yes, those Fed minutes that came out today were somewhat hawkish. The majority of people at the Fed, when it met 3 weeks ago, thought the risk to inflation was greater than the risk of a weak job market. But since that Fed meeting, the Labor Department reported very weak jobs numbers and downward revisions to hiring in May and June. And so I think that tilts the scales for the Fed a little bit towards a rate cut in September. But however, I think the market has also gotten ahead of itself because it's now pricing in 3 rate cuts by the end of the year, 50-50 odds of another rate cut in October. And, I think as we saw in the minutes today, there's still a lot of reason to be concerned about inflation and upward pressure on inflation. And I don't think Powell, he has to acknowledge that the job market looks weaker today than it did the last time that the Fed met. But he can't all of a sudden do a pivot and say, all right, we're now aggressively cutting interest rates, because the inflation numbers have also gotten a little bit worse depending on which numbers you look at. So the Fed is in a very difficult situation right now, putting aside all the political pressure it faces. The economy on both sides of its mandate, employment and inflation, is not cooperating with where the Fed wants to see it go.
All right, we will be watching closely. I know you will be too, John. Thank you as always for your time.
Thank you.
Well, Google announcing its latest line of Pixel smartphones on Wednesday as part of its Made by Google event. For more, we want to bring in here Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, they announced 4 new smartphones. I don't know if that's too many or too few. Basically, what these are: the Pixel 10, the Pixel 10 Pro, the Pixel 10 Pro XL, and the Pixel 10 Pro Fold. Again, a lot. These phones basically get upgrades across the board. We're talking about new processors, better cameras, the kind of fit and finish are much better. They're the foldable phone, the Pixel 10 Pro Fold. Obviously, that's the standout. They say that is now dust and water resistant. It's a big deal for a foldable phone because the hinges on those are usually, easily bring in different debris that can cause damage over time. I think, it's still a little early for foldables. I mean, we've been in the foldable game for a while, but $17.99, it's a lot to ask on the foldable side. I think the real standout here, though, for the phones more generally is the AI smarts that Google is putting in. And sure, they've done this with prior Pixel phones where they add their AI capabilities to them, but there's one in particular when it comes to the Pixel line this time around. It's called this Magic Queue, and basically it's a software feature that acts as kind of, I like to call it like a robot butler almost for your phone. So think you're texting back and forth with a friend, they ask what time reservations are for dinner tonight. It will then recognize that there's a conversation going about reservations for tonight, find that in your calendar, and then bring it into your text message so that you can then send it to your friend. Just get that information right away. Say you have to call an airline, you call United or Delta or whatever, it recognizes that you're calling that airline, and then it'll find your ticket information in your email and pull it up for you so that you're able to see it right away when you're on the phone. This is the way that I think AI kind of starts to make more sense for users. It does things for you without being, a big splashy, oh, this is AI. It's just there and it does its thing rather than calling attention to itself like we've seen with the writing tools and, those weird photo editing tools or, Apple's Genmoji. None of that really, does anything outside of, lets you talk like Shakespeare in an email for some reason. But this is a genuinely helpful tool. And I think going forward, this is what we're going to see more of from the likes of Google and at some point, hopefully Apple.
Dan, you mentioned Apple there. Did you see anything today, Dan, that you thought, hey, this is so cool and compelling and unique that I think, a lot of iPhone fans may ditch that iPhone and move to a Pixel?
No, and look, you're basically either team Apple or team, Google, Samsung. It's going to take a lot of dissatisfaction on either side for you to switch, or just curiosity if you're just into tech. But I think most people, you're basically locked in at this point. As far as AI goes, I know Wall Street is kind of wringing its hands about Apple and AI and where their AI is at this point, and it's a valid question, but I don't see this year or next people being like, well, look, Google's got the AI that sounds really cool. I'm going to ditch my iPhone and everything that I've done with my iPhone for years and go over to Android or Samsung. It's just not going to happen. There's no real compelling AI capability making people want to move. I've said this before. I think that it's a little overwrought, this conversation about Apple and Siri. People are still using ChatGPT, the app. They're not, going to their phone and saying, oh, I really, need to have it directly on my phone and not an app. It's just not going to come. We're going to see small improvements like what Google is doing with this Magic Queue feature over time. And eventually you'll say, hey, my phone has a lot of AI that's interesting now. If you look back 5 years and it didn't, you say, wow, this is a big change. But it's not going to be an overnight kind of thing.
Dan, thank you, sir. Appreciate it as always. And while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.